You've probably seen the pitch. Buy a piece of land, pour some concrete pads, run in a few utility hookups, and watch the money show up every week from people who already own their own hotel room on wheels. No units to build, no roofs to replace, no tenants trashing the kitchen. Just gravel, a fence, and a mailbox for the checks. It sounds like the laziest form of real estate investing that still counts as real estate investing. That pitch isn't fabricated. Cap rates on RV parks really do run higher than almost any other commercial property type, often landing somewhere between 7 and 12%, with distressed or value-add parks pushing past that. Compare that to apartments or office buildings trading in the 4 to 6% range, and you can see why brokers describe RV parks as one of the last inefficient corners of commercial real estate, a place where a motivated buyer can still find a deal nobody is properly priced. But talk to the people who actually own dozens of these properties, and the story changes fast. The men who've built some of the largest RV and mobile home park portfolios in the country don't describe this as passive income. They describe it as one of the more operationally demanding things they've ever done, closer to running a utility company than collecting rent. That gap between how the asset is marketed and how it actually behaves once you own it is the whole story. And understanding why that gap exists tells you almost everything about who wins and who gets quietly destroyed in this business. Why the pitch works for a while. Start with the tailwind, because it's real. Camping demand has outpaced supply for years now. Surveys of campers in 2024 found that more than half had trouble finding an open site during peak season. RV ownership sits at record highs. Remote work turned a segment of buyers into people who live in their RV 9 or 10 months a year, working from a folding table with a good enough Wi-Fi signal. Total industry revenue for RV parks and ground campers in the U.S. is now estimated above $10 billion a year. And even with growth cooling off from its pandemic-era spike, forecasts still point up, not down. On the cost side, the pitch also holds up better than most real estate. A hotel has to gut renovate rooms every few years or watch its reviews collapse. An RV park doesn't own the room at all. The guest brings it. Your job is mostly to maintain the ground underneath: roads, hookups, bathhouses. That's the entire premise behind the low capex argument that gets repeated in nearly every piece of RV park marketing material. Less to fix because the guest owns the thing that usually breaks. Put those two facts together, rising demand and a product where you don't have to replace what wears out fastest, and the math looks almost unfair in the investor's favor. That's why the sweet spot for RV park deals, the $1 to $10 million range that individual investors and small syndicates can actually finance, has gotten more competitive every year since 2020. So if the demand is real and the capex is genuinely lower than a hotel's, where does the difficulty come from? It comes from a detail most buyers skip past on their way to the cap rate calculation. The income that cap rate is built on doesn't happen by itself. The reframe: this isn't real estate, it's a business wearing real estate's clothes. Here's the part that trips up first-time buyers. An apartment building's value is mostly a function of the neighborhood and the unit count. You can estimate the income within a reasonably tight range before you ever meet the tenants. An RV park's value is a function of how well somebody actively runs it, night to night, season to season. Occupancy swings with weather, with local events, with which review site just posted a bad photo of your bathhouse. Rate has to be adjusted constantly, sometimes daily, the way a hotel does it, not set once a year the way an apartment lease is set.
That means the landlord who buys an RV park expecting passive rent checks is actually buying a small hospitality company. The land underneath it is almost incidental to the number that matters, which is net operating income. And net operating income is a function of management skill, not location alone. Two identical parks, same road, same view, same 40 sites, can produce wildly different income depending on whether the person running the front desk knows how to fill a slow Tuesday in March. This is the first correction to the mental model. It looks like a landlord business. It functions like an operator business. And once you accept that, the next question becomes obvious. If income depends on operations, what part of the operation actually produces the money?
Most people picture an RV park's revenue as a string of nightly campers pulling in for a weekend, paying $40 or $50 a night, then leaving. That customer exists, and at a well-located park during peak season, nightly transient guests can be lucrative. But at a huge number of parks, especially outside of prime tourist corridors, the real money comes from a completely different tenant. The long-term or seasonal resident who parks a single RV on a single site for months, sometimes years, and pays what amounts to a lot rent. This matters because the economics of a long-term tenant look nothing like the economics of a weekend camper. A long-term resident doesn't need daily housekeeping, doesn't need a front desk handling check-in and check-out, and often pays their own utilities back to the park through a metering or bill-back arrangement, meaning the park owner can recover water, sewer, and electric costs directly rather than absorbing them as an operating expense. Industry veterans describe long-term and seasonal tenants as the quiet backbone of a lot of RV park cash flow, even though they're the least visible part of the business to an outsider driving past a full lot on a Saturday. That produces a strange result. A park can look fully occupied to a casual observer, rows of RVs as far as you can see, and still be underperforming, because a full lot of long-term $400 a month tenants generates very different income than the same lot turning over nightly guests at market rate. Occupancy on its own is close to a vanity metric. What actually matters is revenue per site, blended across the mix of long-term, seasonal, and transient guests. And that number can hide a genuinely weak business behind a genuinely full parking lot. That single distinction, full doesn't mean profitable, is also the crack that some of the roughest chapters in this industry's history opened up through. Because if long-term tenants are the quiet backbone of park income, the way an owner treats that captive, low-turnover population becomes the whole ballgame. And that's where the story turns. The infrastructure bomb underneath the low capex pitch. Before getting to what happens when an owner gets that relationship wrong, there's a second correction to make, because it explains why so many of these deals go sideways financially, even under good management. Remember the pitch that RV parks are low capex because the guest owns the room? That's true for the visible asset, the RV itself. It is not true for what's underground. Water lines, sewer systems, septic fields, well pumps, and electrical panels are the actual infrastructure of an RV park, and they are frequently decades old, poorly documented, and invisible during a walkthrough. A buyer can tour a park, see full hookups at every site, and have no idea that the septic field is nearing failure or that the electrical system was never upgraded for modern RVs that draw far more power than the units from 20 years ago. This is where due diligence guides for the sector keep landing on the same warning, almost word for word. Infrastructure age is the risk that's hardest to see and easiest to underprice. A failing septic system isn't a maintenance line item. It can mean an entire section of the park goes offline for weeks while it's dug up and replaced, during which those sites earn nothing while the debt on the property keeps accruing regardless. So the two halves of the pitch, real estate that's cheap to maintain and income that flows in passively, both turn out to be less true the closer you look. The capex isn't gone, it's just buried, literally underground, where an inexperienced buyer won't find it until it fails. And the income isn't passive, it's a function of daily operational skill applied to a tenant base that behaves less like renters and more like hotel guests who never check out. Put those two corrected facts together and you get the actual chain of events that plays out again and again in this industry. The chain reaction. It usually starts with financing. Because RV parks are a smaller, less institutional asset class, sellers frequently offer owner financing, a low down payment, seller-carried note, easy entry for a buyer who couldn't qualify for a conventional commercial loan on a bigger property. That accessibility is part of what makes the sector attractive to first-time investors. It's also exactly how undercapitalized buyers end up owning parks they can't actually maintain. An owner who's stretched to make the down payment has little left over for the infrastructure work that isn't visible on day one. Maintenance gets deferred, not out of negligence, but out of necessity. A leaking pipe gets patched instead of replaced. An aging electrical panel keeps running until it doesn't. Deferred maintenance compounds quietly for a year, 2 years, sometimes longer, while the books still show positive cash flow because deferred maintenance is by definition money you haven't spent yet. Then something fails, a septic backup, a water outage during a holiday weekend, a breaker panel that can't handle August demand. Guests notice immediately, and RV travelers talk to each other constantly, on forums, in Facebook groups, in reviews left the same night. A reputation that took years to build can take one bad season to unravel, and occupancy, remember, the metric that looked healthy, starts sliding at the exact moment the owner needs cash to fix the underlying problem. That's the trap closing. Revenue drops just as the capital needs spikes, and the debt service on that owner-financed note doesn't pause to wait for repairs. Owners in exactly this position either sell at a discount to someone with deeper pockets, or they default, and the note reverts to the seller or lender. Either way, the park changes hands again, usually to a buyer with more capital and more operational experience than the one who's leaving. That's not a hypothetical pattern. It's the same mechanism that has driven consolidation across the mobile home park world, a close cousin of the RV park business. And it's visible in the career of the two men most associated with buying distressed parks at scale. There's one more layer to this chain that most buyers don't think about until it's too late: how the park gets valued in the first place. Commercial real estate is usually priced by comparing it to similar recent sales, comparable buildings, comparable neighborhoods. RV parks are priced almost entirely on income, using the net operating income divided by the cap rate. That sounds straightforward, but it means the sale price is only as reliable as the seller's financial statements. And those statements are the easiest thing in the world to make look better than reality for 12 months. A seller who's about to exit has every incentive to raise rates on long-term tenants right before listing, delay a maintenance expense until after closing, and skip a slow off-season rather than average 3 years of income the way careful buyers are advised to. Due diligence guides in this space consistently push buyers toward multi-year financials for exactly this reason, because a single strong year is often the seller's exit strategy, not the park's baseline. That creates a second version of the same trap already described. A buyer who underwrites off one flattering year, finances the purchase with a thin down payment, and inherits infrastructure they haven't yet inspected properly, is stacking two separate risks on top of each other before they've even closed. The income might already be inflated. The capex might already be overdue. Both facts stay hidden until the first hard season, and by then, the debt is already in place. The case study. Frank Rolfe and Dave Reynolds built one of the largest portfolios of mobile home and RV parks in the United States. At their peak, ranked as high as the 5th largest owner in the country, with a portfolio reported north of $1 billion across more than 500 properties in over 25 states. Rolfe has told the story of his own first deal, a rundown park in Dallas called Glenhaven, which he bought with essentially no idea how the business actually worked. It came with a master metered gas and electric system, meaning the owner, not the tenants, was on the hook for the whole park's utility bill, one of the exact structural traps that experienced operators now warn new buyers to avoid. He turned it around and eventually sold it for a profit, and that experience became the seed of a much larger strategy. Buy distressed, undermanaged parks cheap, fix the operations and the infrastructure, and refinance or hold for stabilized income. That thesis is now taught in codified form through the education business the two of them run. But the same playbook that made them wealthy also produced one of the most publicized tenant conflicts in the industry. In 2014, a company tied to Rolfe and Reynolds bought North Lamar, a small manufactured home community outside Austin, Texas. Within a year, rent increases and enforcement actions were generating local news coverage, and by the time reporters, advocacy groups, and residents got involved, the story had been picked up by national outlets. The residents ultimately organized, and in 2020, with support from a nonprofit resident ownership network, they raised the money to buy the property back from the operator themselves for just over $6 million. What that case actually demonstrates isn't a morality tale about one company. It's a clean illustration of the mechanism running underneath this entire asset class. A long-term, low-turnover tenant base is the quiet backbone of park income, precisely because those residents have almost nowhere else to go. Moving a mobile home is expensive and often impractical, and moving an RV that's become someone's primary residence isn't much easier. That captive economics is what makes the asset so profitable for a disciplined operator. It's also what makes it so easy to extract value from tenants faster than the market would otherwise allow, and why this sector draws regulatory and reputational scrutiny that a normal apartment complex rarely faces. The upside and the controversy come from the exact same structural fact. How the industry adapted. The response to all of this across the sector has been consolidation. Large, well-capitalized operators, publicly traded real estate investment trusts among them, have spent the last 2 decades buying up individually owned parks, standardizing operations, and applying institutional-grade systems to an asset class that used to be run by whoever owned the local gas station and decided a field of RV hookups looked profitable. Franchise systems for campgrounds now offer smaller operators a version of the same standardization without giving up ownership, in exchange for brand affiliation and shared booking infrastructure. The financing environment shifted too. Cap rates that compressed through the 2021-2022 camping boom ticked back up in 2024 as interest rates rose, meaning the same income now supports a lower purchase price than it did 2 years earlier. A correction that squeezed both new buyers trying to get in and existing owners trying to refinance debt taken on at boom-era valuations. Brokers covering the sector describe a widening gap between what sellers think their parks are worth based on the pandemic-era peak and what buyers are actually willing to pay now that borrowing costs are higher and underwriting has gotten more conservative about deferred infrastructure. None of that has slowed the larger players down, and that's worth sitting with for a moment because it's not a coincidence. A rising rate environment that punishes a thinly capitalized independent owner is the exact environment a well-funded consolidator wants. When a small operator's refinance no longer pencils out or their next infrastructure bill arrives at the worst possible time, the buyer waiting on the other side of that distress sale is disproportionately likely to be a company with a standing acquisitions team, established debt relationships, and the operating systems to fix what the previous owner couldn't afford to. That's the mechanism behind consolidation in plain terms. It's not that big operators are simply better at finding deals, it's that the structure of the asset class manufactures distressed sellers on a fairly predictable cycle, and the buyers positioned to absorb them keep getting bigger as a result. The honest comparison. So what does ownership actually look like stripped of the pitch? In the best case, a buyer with real operating capital and hospitality experience acquires a well-located park, invests in the infrastructure most competitors ignore, builds a mixed base of transient and long-term tenants, and earns the double-digit returns the marketing promises, while also building the kind of reputation that keeps occupancy resilient through a soft season. In the realistic successful case, that same buyer earns solid but unglamorous returns, spends more time and capital on operations and maintenance than they expected going in, and treats the passive income framing as something they've mostly outgrown by year 2. In the realistic negative case, an undercapitalized buyer gets into a deal through owner financing, defers the infrastructure work they can't yet afford, absorbs a reputational hit when something underground finally fails, and sells at a loss to someone better capitalized, feeding the same consolidation trend that's reshaping the industry. And in the failure scenario, the specific one that shows up again and again in the mobile home and RV park world, an operator who treats a captive tenant base purely as a source of extraction runs into the same wall Rolfe and Reynolds hit in Austin: bad press, organized resistance, and, in the most extreme cases, losing the property entirely. What this business is really about. The opening pitch made RV park ownership sound like the easiest kind of real estate you could buy: dirt, concrete, and a mailbox. The real version is closer to running a small hotel built on top of a small utility company, serving a customer base that, once they've settled into a site, has real incentive to stay and real difficulty leaving if things go wrong. The land is almost the least important asset in the deal. What actually determines whether an owner gets rich or gets wiped out is who controls the 2 things a drive-by tour will never show you: the condition of what's buried underground and the character of whoever is deciding how to treat the people who can't easily pack up and go somewhere else.